The 3 ETF portfolio offers a straightforward path to wealth accumulation over time without the complexities of stock selection or the risks associated with day trading. It involves long-term investment in just 3 ETFs. While the idea of using only 3 ETFs may seem too good to be true, it's a strategy I've employed for years, not only for achieving high returns, but also for generating passive income through dividends. In this video, I'll delve into the concept of a 3 ETF portfolio by dissecting each element, selecting the optimal ETFs for each segment, managing the portfolio effectively, and sharing insights from my own investment journey. The original 3 ETF portfolio was pioneered by investing icon Jack Bogle in the 1990s, comprising U.S. stocks, international stocks, and U.S. bonds, offering simplicity and consistent growth without the stress of individual stock picking. If you were to invest $500 monthly for 25 years using this traditional portfolio, you'd accumulate over $420,000. However, by modernizing it with the version I advocate, you could amass over $1.10 million, a substantial improvement. For beginners, an ETF, or exchange-traded fund, is akin to a collection of various stocks bundled into one investment. A 3-fund portfolio operates on 3 key principles: selecting one ETF for each category, defining a clear investment objective, such as focusing on dividends, growth, or both, and maintaining a steadfast approach even during market downturns. The ETFs I'll discuss in this video are of high quality and are likely to recover post any market setbacks. The revamped 3 ETF portfolio features a foundational ETF, which forms the core of your investment strategy. It's designed for long-term holding, offering stability, peace of mind, and consistent returns. I believe 2 ETFs stand out as excellent choices for the foundational ETF category: an S&P 500 fund like Vanguard's VOO, or a total stock market fund like Vanguard's VTI. Additionally, I've identified some other noteworthy funds that can substitute for either VOO or VTI, which I've curated using M1 Finance. You can access the link in the video description, where I've compiled the best ETFs for this category into a portfolio. You might be wondering, why opt for an S&P 500 fund or a total stock market fund for the foundational ETF? The S&P 500 has historically delivered robust returns averaging over 10% annually since 1957. It encompasses over 500 of the largest and top-performing companies globally, such as Apple, Microsoft, Tesla, Coca-Cola, and many others. VTI is equally compelling as it includes all U.S. stocks, ranging from small-cap to mid-cap companies, providing greater diversification. Despite major economic downturns like the Great Recession in 2008 or the tech bubble burst in 1999, the S&P 500 has consistently risen. Even amid the pandemic in 2022, investing in the S&P 500 or a total stock market fund would have yielded significant returns due to their historical performance. The subsequent element of a 3 ETF portfolio aims to deliver a blend of steady income and security, which I refer to as the dividend ETF category. Traditionally, the old 3-fund portfolio utilized bonds for this purpose because historically, bonds offered stability and safety with modest returns in the form of dividends or interest rates known as yield. The old portfolio relied on BND by Vanguard, a total bond market ETF, but its returns have remained low at approximately 1.5% annually over the past decade. This effectively erodes your purchasing power due to inflation. In the modernized version of the 3 ETF portfolio, dividend stocks or dividend ETFs replace bonds. These assets are less volatile compared to the S&P 500 because the companies within these funds experience slower growth in their cash flows and revenues compared to growth-oriented stocks in the S&P 500. These dividend-paying companies are often seen as less flashy, but possess solid business models that have stood the test of time. They reward investors with significant dividends as an acknowledgement for investing in their company, and these dividends increase annually, offering more returns without additional effort. 3 dividend ETFs I recommend for this category are SDY by Charles Schwab, VYM by Vanguard, and DGRO by iShares. Additionally, I've curated alternative funds I favor for this category, which you can find in the video description. Personally, I hold SEHD by Charles Schwab and DG by iShares in this category. I maintain both because one is in my Roth IRA, while the other resides in my taxable brokerage account. Although they serve different purposes, I'll elaborate on that later. Both these ETFs exhibit strong capital appreciation potential and offer dividend yields ranging from 2% to 3%. Consequently, your investment grows steadily, and your dividend income compounds over time, potentially covering substantial expenses such as a mortgage, car payment, or even luxurious dining. For instance, if we invested $50,000 into BND, it would only grow to $58,000 in a decade. In contrast, investing in something like SHD with its 10-year annual returns. If we invested $50,000 into SD over a decade, we could potentially accumulate nearly $150,000, in addition to receiving a 3.3% passive income from SD's dividends. This significantly outperforms traditional bonds. By incorporating SD into our 3 ETF portfolio alongside our foundational ETF, like the S&P 500 ETF VOO, we would experience an 8% overlap in funds. While a high fund overlap isn't necessarily detrimental in my view, it implies that our diversification might not be as extensive as we assume. A lower fund overlap percentage indicates a more diversified allocation across various asset classes. The old 3-fund portfolio previously categorized its final segment as international stocks, which I refer to as the growth category. Although it carries higher risk, it also offers higher potential rewards. In the past, diversifying into international stocks and funds made sense due to limited technological advancements hindering global business expansion. However, with technological innovations today, US-based companies like Apple and Microsoft sell their products worldwide, making them essentially global companies. An example of an international fund in the past was Vanguard's VXUs, which delivered an average annual return of around 4.5% over the last decade. By substituting the international segment with growth ETFs, you can capture the top-performing growth stocks on a global scale. In my view, some of the finest ETFs for the growth category include Invesco's QQM, SG by Charles Schwab, and VUG by Vanguard. I've compiled a summary of alternative funds in M1 Finance, as mentioned earlier, accessible via the link in the description. Personally, I hold both SCG and QQM in 2 of my 3 ETF portfolios across different investment accounts. With an ETF like SG, you can achieve returns that outpace the S&P 500, averaging around 15% annually. The high returns from SG and growth ETFs stem from their investments in tech stocks, which are classified as growth stocks. These companies experience rapid growth in profits and revenues each year, leading to increased share prices due to their swift expansion. Let's summarize the 3 ETF portfolio we've constructed, one that I've personally invested in. Our foundational ETF is Vanguard's VOO, our dividend fund is SCD by Charles Schwab, and our growth ETF category is SCG by Charles Schwab. We'll employ a backtester to compare our new 3 ETF portfolio with the old 3 ETF portfolio of VOO, BND, and VXUs, as well as a scenario of investing solely in the S&P 500 over the past decade with $100,000. The new 3 ETF portfolio emerges as the clear winner, boasting the highest historical annual return and outperforming not only the S&P 500, but also the old 3-fund portfolio. I manage 2 3 ETF portfolios, one in my Roth IRA, focusing more on growth-oriented investing with VOO by Vanguard as the foundational ETF, SCG by Charles Schwab as the growth ETF, and DGRO by iShares in the dividend category, with SCG having the highest allocation since it's a growth-focused account. In my other account, which is a taxable brokerage account, the foundational ETF is VOO by Vanguard. The dividend ETF is HD by Charles Schwab, and the growth ETF is Invesco's QQM, with VOO having the largest allocation as this portfolio leans towards a growth and income investing style. Consistently practice dollar cost averaging, DCA, into your ETFs to secure the best possible prices, since our focus is on long-term investment rather than short-term gains. Wealth accrues over time, not overnight. So whether prices rise or fall, maintain your DCA strategy. This involves purchasing regularly, be it daily, weekly, or monthly, whatever suits your strategy. Stay consistent with your fund purchases, and I assure you'll witness significant returns over time, facilitating a comfortable retirement. That concludes this guide on the optimal 3 ETF portfolio for long-term investment. If you found this video helpful, please give it a like and share your thoughts on the ETFs or 3 ETF portfolio you're investing in for the long haul. Wishing you a fantastic day, week, or evening ahead. Keep excelling in the stock market and take care. Peace.